When you sell your company, you could get three offers on the same day, millions of dollars apart. And all three are right. Here are three of the buyers you'll meet. There are others, but start with these. The first is growth equity. They're investors who usually take a minority stake, less than half the company. So it's a partial sale. You stay in control and take some money off the table while you keep running it. They'll often put the highest multiple on paper because they're paying for your growth curve, not your profit. But that only holds if your growth metrics back it up. The second is a financial buyer. Private equity is the one you've heard of. They're buying your numbers. They take your profit and pay a multiple of it. Earn $2 million, and at a 6 times multiple, that's a $12 million deal. They're the most conservative of the three because they're borrowing to buy you and the profit has to cover the debt. And they usually want your team to stay because your team is what keeps that profit coming. Now the third buyer is usually willing to go highest, and this is the one every founder hopes for. That's a strategic buyer, a bigger company already in your market, and they're not just buying your profit. They want the profit too, but they're also buying what you do for them. They already have a marketing team, so that cost disappears the day they buy you. And they can sell your product to their customers in year one. Historically, that's been worth a turn or two more than a financial buyer pays. But here's the catch. Strategic buyers can move slowly, and they don't always have the cash sitting ready. Private equity does. They've raised a fund, and they're on a clock to deploy it, so sometimes speed is worth more than the highest number. And that strategic premium isn't automatic anymore. It comes down to how well you fit that one buyer, not what category they're in. So the question was never, what is my company worth? It's which buyer is it worth the most to? Save this and comment worth for the buyer map.